speakers here.
I've just been
So,
promoted to
hello
panelist.
everyone, and welcome to the second. Oh, okay. Thank you. Now I see you. So just in time, Austin. So hello everyone, and welcome to the second Africa Impact Summit webinar series. My name is Etemere Glover, the CEO of the Impact Investors Foundation, IIF. IIF is a non-profit organization established to accelerate the growth and excellence of impact investing in Nigeria. And we are the Nigerian partner of the GSG Impact, and also one of the member organizations of the Africa Impact Investment Group. Together, we are innovating, accelerating impact investments, unlocking capital at scale, and addressing barriers locally, regionally, and globally. Welcome again to the webinar. So please, everyone, put your name down, your organization, and where you are joining us from this call. Let's get to know everyone that is participating. Right. So today's topic is mobilizing capital at scale in a changing global landscape. A conversation that will start today and frame, but the insights and recommendations we will gain from today will form part of the conversation for actionable solutions at this year's Africa Impact Summit. So if you haven't registered, please do so. We will be holding this year's Africa Impact Summit in Accra, Ghana from June 11th to 13th. And also there will be a pre-event study tour in Lagos, Nigeria. So I'd like to host you where you get to meet our vibrant people doing great things across various sectors. And we'd like to use this opportunity to showcase these industry leaders, businesses, and let you have investment opportunities that are all Nigerian. So today's webinar on mobilizing capital at scale in the changing global landscape, you will agree with me, is very timely. And this is because of the international financial landscape that is undergoing profound transformation, shaped by factors like geopolitical tensions, nationalist and regionalist policies, and shifting priorities in foreign aids. We've seen the US aid being cut off and so many other aids coming to the continent. And we see a rise of protectionist policies, particularly across Western economies. And this has led to a decline in development assistance to Africa and many emerging markets. And what does this pose for Africa? It poses both opportunities and threats. So given the obvious challenges that we have as a continent, we need to mobilize massive capital to finance our SMEs, to bridge the SDG financing gap, the gender gap, and also infrastructural financing gaps. So traditional capital sources are dwindling because of these shifts and as well as the policies. Africa must embrace alternative financing. We must mobilize local capitals. We must leverage blended finance and strengthen our intra-African investments and foster business-friendly policies, among others. So today's discussion, we will explore the strategies to unlock Africa's financial potential. And with me, I have three experienced panelists who will be unpacking today's topic. And allow me to present them to you. They'll be introducing themselves in a minute. I have Hamdia Ismaila. Please turn on your camera. And Amit Achame Singh. And finally, Austin Moakwe. These are your panelists today. So I'd like to invite you one by one to please introduce yourselves and your organizations, and then let's speak broadly for 2 minutes about the topic. Let's unpack it broadly. So let me call on the lady first, Hamdia Ismaila. You're muted, Hamdia. Okay, can you try again? Okay, while we are waiting for Hamdia is experiencing some technical challenges, and Hamdia will give you some time to sort that out. I will jump to it. Amit, please introduce yourself and your organization, and 2 minutes to look at the topic quite broadly.
Thank you a lot, Etimore, for this wonderful opportunity to be here. A great group in the call here, more than 50 participants, which is great. So basically, my background is in economics. I've studied a Bachelor of Economics about 25 years ago, and then I've moved into economic policy and development in Mauritius, and then I've studied a Master's of Professional Accounting in Australia to have a holistic view of the ecosystem in which I was evolving at the time. And in 2017, I started a PhD in development finance while also setting the National Advisory Board of Impact Investing in Mauritius, which is part of the Global Steering Group, ESG Impact, which has been rebranded, by the way. It's now called National Partners. So in terms of the topic today, I feel that this is a very timely moment, Etimore, really to look at the evolution of the events which have just been part of the global ecosystem. If you look at those exogenous shocks, we should say, whether it's in terms of trade wars, geopolitical shifts, or even before the COVID pandemic, it has brought to our attention that there is a pressing need for many African countries to embrace many reforms, be it monetary, fiscal, labor market reforms, capitalizing on free trade agreements like the AFCA, for instance, which I remember it was signed, I think, in 2018. But we have yet to make progress on this, and I will also intervene on these issues as we move along. Thank you.
Thank you very much for that brief introduction of yourself. And we'll jump next to Austin. Amdia, please confirm if you are able to speak so that we'll come to you after Austin.
Thank you very much, Etimore. Are you able to hear me?
Loud and clear.
Oh, lovely. Yeah, my name is Austin Mwab. My work background is that I've been a central banker for quite some time. I worked for the Central Bank of Zambia for 28 years. I joined the central bank from graduate school and rose through the ranks and exited as a deputy governor in 2011. Since then, I've worked as a senior financial sector consultant for the World Bank, with mainly in the Horn of Africa, helping the central banks there restructure. Beyond that, I also was part of the initial team which put together the task force, which transformed into a national advisory board. I chaired the task force and have been part of the Zambia national partner since then. I chaired the task force, but now I just sit on the board. I also chaired the board of Stanbic Bank, which at the time was the second largest bank in Zambia. I am currently chairing the board of Absa Bank Zambia Limited, which is also one of the largest, I think the third largest bank in Zambia. In terms of my education, I did my first degree here in Zambia, a BA in economics with business. Then I did a Master of Science in Industrial Economics at the University of Lancaster in the UK. And finally, I did my PhD in finance at the University of London. I'm happy to be here with you. Thank you. Hello,
Thank you
Etimore.
very much. We're happy to have you, Austin, as part of the conversation. And now we'll jump to Hamdia. Yes, can you hear me? Hamdia, can you go on? This is funny. We were hearing you during the huddle. I'm quite surprised that we can't hear you. So I'd like to, maybe you may want to log out and log back in. We'll give you an opportunity. I'm struggling. No, we're struggling to hear you. So what we'll do now is to just go into the conversation proper, Hamdia, and we'll come back to you. Can anyone else hear Hamdia? Okay, so we're just going to the conversation
He's on
proper.
mute.
And can anyone hear me?
Yes, we do. We do. Yes, we
Yes,
hear
thank
you.
you. Thank you very much for confirming that. So we're
Yes.
just going to the conversation proper, and I wanted my first question to go to Hamdia, but it's a broad question which I would like to ask and have us unpack is how can African nations reduce their dependence on foreign aid and mobilize domestic capital effectively? Ghana is doing quite well with the Chigaba Fund, and I wanted Hamdia to speak to that and see if we can take any learnings from that. But I'll come back to her when she's ready, but I'll channel this question to you, Austin. One being that we know the potential that we have as a continent, and we are not exploiting our opportunities. Let's take a look at the Africa Free Trade Zone, for instance. We've not fully leveraged it. While it has potentials to boost regional income of up to $450 billion and lift about 30 million people out of extreme poverty. When you look at intra-trade within the continent, it has the potential to increase by 276 million. Why are we not looking internally? And how can we shift our focus and mobilize capital within the continent and move away from foreign aid dependence? Austin.
Thank you very much, Etamo. I mean, the aid has been a key part of Africa's DNA. However, geopolitical developments are beginning to challenge the sustainability of this status quo. And Africa's path to resilience, self-finance development lies basically in its ability to mobilize domestic capital, not maintaining dependence on aid. This transition requires more than just rhetoric. It demands institutional innovation, regional scale, and targeted de-risking. This is where the African continent free trade area becomes transformative. The AFCFTA is more than just a trade deal, in my view. It's a game changer for domestic investment. By connecting, as you correctly say, 1.4 billion people across 55 countries, it creates scale, lowers transaction costs, and builds investor confidence through predictable continent-wide rules. This helps African institutional investors like pension funds and insurers find and fund bankable opportunities in sectors like manufacturing, agribusiness, and logistics. It also supports regional markets by harmonizing regulations and enabling cross-border investments. But to unlock the full potential, we need strong national institutions, project preparation facilities, and risk-sharing tools. AFCFTA is our path to an Africa where domestic capital drives on development. There is adequate capital in our domestic financial markets. The challenge is, how do we harness it? Let me just illustrate this with a homegrown solution. In Zambia, the Zambia Small Business Growth Initiative. The SBGI is promising. It's a promising example of how public capital can unlock domestic institutional investment, not through subsidies, but through strategic design that makes unique. What makes it unique is that, one, it is a blended finance anchored in risk sharing. The SBGI uses public funds as first loss capital, creating a cushion that encourages pension funds and other investors to participate. This de-risks investments in SGBs in small growing businesses that would otherwise be seen to be too risky without distorting the market. It also embeds technical assistance. The initiative integrates business development support facility that provides hands-on advisory services to small businesses and financial intermediaries alike. This has potential to improve creditworthiness, reduce defaults, and build capacity across the ecosystem. It has performance-based incentives for financial institutions. It does not just subsidize lending, it aligns it with performance metrics. Financial institutions receive capital incentives only when they meet lending and risk-sharing thresholds. This ensures accountability and crowding in market discipline. It is also anchored on local capital and local control. Unlike donor-driven facilities, the SBGI is locally owned and governed with regulatory alignment that enables domestic pension funds, DFIs, and insurers to invest safely and within their mandates. These features increase the probability of success because they balance risk, incentives, and sustainability while preserving the commercial integrity of the private sector. And here's where the African continent free trade area makes the SBGI even more scalable. It allows small business finance under such models to access regional markets, expand operations, and reduce investment risk through diversification. This reinforces the case for local capital to stay on the continent. The lesson is clear. Public funds should not replace markets. They must activate them. The SBGI model shows the smart public design that can make African savings work for African growth without relying on aid. It is cardinal that we scale that works. It's cardinal that we scale what works. Mm-hmm. We need to align reform with continental ambition. I'll pause there. Thank you.
Yeah, thank you very much, Austin, for giving us a case in Zambia with the Small and Growing Business Initiative, which I think once fully implemented, it has a potential of mobilizing massive capital from various sources, particularly institutional investors. I like the fact that it also provides credit risk guarantees so that financial institutions can also participate in giving out, investments to SMEs. And I know across Africa, not many financial institutions are out there lending to SMEs. So SMEs are really starved. So I want to take this question to Hamdia from her own perspective in sharing with us what is happening in Ghana and how we can create vehicles that can bring in both public and private sector and help us, reduce the dependence on foreign aid. Hamdia, are you there? Do you want to share with us the case study from Chigaba, what you're doing?
Can you hear me now?
Yes, I can hear you loud and clear. Welcome. Okay. Hamdia, we are really struggling to hear you. I'm not quite sure why. So I'll just. So you want to mute your original. Okay, can you speak now?
Can you hear me?
Loud and clear, Hamdia.
So
did you hear the question?
Better? Yes, I did. Okay. I think if this is good, then that's perfect. And thank you. I don't know why I was having issues. But yes, in Ghana, we've been working over the last 2 years trying to put a vehicle to be able to mobilize domestic capital. And I have lost out a little bit of what both Amit and Austin said. And so forgive me if I might have repeated some of them, or maybe I should just go straight to what we are doing with Chiga. But what we noted was that to be able to to support. We have a diversified private sector, majority of which are SMEs. Most of them are informal sector and they are very small. And so we needed to be able to find a vehicle that can mobilize private capital locally to support this asset class, these small businesses, to make them grow, because one of the ways that our countries can reduce our dependency is to make sure that we effectively diversify the economy by making sure that private sector grow. And to get the private sector to grow, we need to support more SMEs, because our market is more SMEs than anything else. So the vehicle is aimed at raising money from, especially our target is the pension funds locally, and we want to raise more money from the pension funds. We set up a structure that allows the pension funds to invest with a point where other catalytic investors will also come in. So what we've done is to ensure that we engaged the private capital institutional investors, try to understand what their needs were, what was stopping our institutional investors from investing in institutional grade vehicles. And out of that, that conversation, which was led by Impact Invest in Ghana, we were able to understand how to be able to meet the needs and the demands of the institutional investors. So the Chigaba vehicle was designed with these institutional funders in mind, and to meet their needs. And so we were able to immediately get a couple of them on board. And that is where we are. We should be launching the fund very soon, doing our first close very soon. Already we have a warehouse of capital coming from one of the institutional investors that we're already deploying, and we are looking to do our first close very soon and start investing in these VC SME vehicles across the West Africa region.
Yeah, thank you very much, Hamdia, for that. I want Amit to chime in this, because when we talked during the huddle yesterday, it was clear that we needed massive mobilization of capital into the continent, given the financing gap. For instance, we know we require about $331 million to finance SMEs, and in Nigeria we're raising 1 billion for the wholesale impact investment fund to be deployed over a 10-year period. Hamdia corrects me, the Chigaba fund about 70 billion, and Austin, the SGBI is about 100 million first close. Is it enough? I mean, what do we do as a region to mobilize more capital to fund SMEs infrastructure?
Yes, thank you, Echimori, for this question. So I would like to approach this question in a layered approach. For instance, countries like Mauritius, and this is not by no means exclusive to Mauritius, and all those policy that I've explored over the decades with prominent economists from the US Federal Reserve and in UK, I feel could be implemented in Africa. Let me give you some insights into what I'm talking about here. If you look at the context of Mauritius, for instance, we are very much exposed to shocks like pandemics, geopolitical shifts, trade wars. As a matter of fact, if you look at the figures, Mauritius relies mostly on imports. 90% of its foodstuff are imported from abroad, which means we are very vulnerable to changes in geopolitics and trade wars, obviously, and even the COVID pandemic, we felt the burden really at the time. So in terms of renewable energy also, I'm talking about those impact sectors, which are also very relevant for the rest of Africa. If we've seen how the financial sector across Africa has been evolving over the past decades, we've seen that most countries are bank-based systems, because you think about it, stock markets are not very well advanced in African countries, right? We're not talking about New York Stock Exchange or NASDAQ. We're not talking about those kinds of highly liquid stock markets here. Most countries rely on banks or credit schemes of similar financial institutions, really, to spearhead growth into impact sectors. But we have seen from past experiences and past empirical studies, I want to highlight this point here because this is not an opinion, it's based on empirical evidence that I'm talking about here. We've seen that, for instance, in Mauritius, we've seen that over the past 30 years, banks have had a skewed incentive to lend to construction, real estate, offshore companies, which are low impact sectors, obviously, which means, therefore, that we need models or policy frameworks that will help to address this overinvestment in those sectors. We have gone way past the optimal level of investment in real estate in Mauritius. So we need to clamp down on those, now I would say, relatively unproductive investment, encourage investment which are more productive. And in this sense, then, the good news is that in the face of adversity, this is where we become stronger. If we can use the chaos outside, shield ourselves, and try to implement policy reforms. Let me give you, I really want to explore this point with you here. Quantitative easing, which many of you have heard, has been used in many times of crisis to stimulate economic growth. But the way it has been used across the world, basically, what is quantitative easing? Basically, what central bank purchases government debt, right? Expecting it to reduce interest rate and then to promote investment, right? So quantitative easing has been believing, the advocates of quantitative easing in this form has been believing that through interest rates, investment will be stimulated. This is not what happened. But the way really to implement quantitative easing, which has been advocated by Professor Werner in UK and many professors like Stiglitz around the world, is basically to stimulate directly bank lending and not to pass through interest rate. What do I mean by that? If bank lending is channeled to more productive sectors through very creative credit schemes which can be put in place, which have been in place in Mauritius, by the way, from 1973 to 1993. And coincidentally, when we removed those credit schemes in 1993 in Mauritius, this is where we've seen that banks started to finance construction, real estate, and offshore sectors. If you look at the 1980s in Mauritius, and by the way, other countries in East Asia has adopted the same model of development, which means targeted bank credit creation with quantitative restrictions on unproductive sectors like real estate, financial transactions. Because think about it, my dear friends, if you give a bank credit for the buying and selling of land, it adds zero value to production and to GDP. And one major component in all construction and real estate is land. And if you look at the macroeconomic effects of the skewed bank lending towards real estate in Mauritius, it has generated massive increases in land prices, which means, therefore, that those externalities are very important, because if you understand those side effects of those financial market liberalization policies, which said to us that we would mobilize more capital by liberalizing financial markets, banks would have an incentive to finance productive sectors. This is not what we have seen. So what I'm saying there.
Let me stop you there. So just in summary, you're talking about policies that would enable banks to direct investment. It has a huge potential of mobilizing capital to SMEs through banks and not using quantitative easing and using monetary policies alone.
No. Very good question, Itibor. It's important that you come in between so that I can even clarify even further, because these are quite technical terms. What I'm saying here, I'm not saying that we have to use quantitative easing in the proper way, as it was proposed initially by the economists who coined this term. I will encourage all of you here in the audience to go and type on Google who introduced the concept of quantitative easing. You will see it was introduced in 1995.
I will pause you there. You know why I'll pause there? Because I'll call you back to speak to that. You gave an example during the hurdle about how quantitative easing was used wrongly by Japan, and we see it playing out here in Africa. So I think it will be instructive for us to learn how not to use quantitative easing and how we can use it to mobilize capital.
Just want to add.
So
Also,
I'll come back to you.
Just 1 minute. Just 1 minute before I just complete. I just talked about mobilizing domestic capital for more bank credit creation here. I just want to also touch on this international capital part also here. My argument, and many economists around us who have been studying these topics for decades, foreign direct investment is also part of international capital. Think about it. We are not talking about foreign direct investment again in those same sectors like construction and real estate, but we are talking about foreign direct investment which have huge skill and technological transfer. This is what we need in Africa. We don't need to reinvent the wheel again. Massive research and development, all the technologies are very available in the developed countries. We need to absorb those technologies from abroad. This is something we have not been doing in Africa, and this is also part of international capital. So complementing international capital with those policy reforms that I talked about, using rightly the quantitative easing in the way we should, could help to mobilize capital at scale. And I'll talk about later how East Asia has done that, for instance.
Yeah. Thank you very much, Amit, for your insights. Still on foreign direct investment and looking at international investors and their roles that they can play in mobilizing capital. To you, Austin, since you've worked in the Central Bank of Zambia for over 2 decades, and with a wealth of experience as a World Bank consultant and a financial expert, you of all persons, you know the role or the importance of mobilizing capital to bridge financing gap in Africa through foreign sources. Now tell us, what role do you think international investors and also multilateral development banks can play in bridging this financing gap?
Thank you. My internet is playing up, so I've removed the video, if you don't mind. Yeah, the question is both timely and complex. I mean, Africa's financing gap, especially in infrastructure, energy access, and SME development, remains large and persistent. But today, it must be addressed in a global context marked by geopolitical fragmentation, climate urgency, and the tightening of global capital markets, reshaping the capital flows. We are beginning to see a shift from globalization to geo-economic blocks, with capital increasingly flowing along political lines, what some may call friend shoring. This effectively means that Africa risks being deprioritized unless it strategically positions itself as both a neutral partner and a high-impact investment frontier. Multilateral development banks and their mandates for stability and development need to step up to buffer Africa from this fragmentation by mobilizing patient capital and protecting long-term investment pipelines. You're looking at sectors like clean energy, agri-value chains, and regional infrastructure. The MDBs must also shift from lenders to risk sharers. What do I mean? In a world of tighter liquidity and high debt servicing costs, multilateral development banks can't just lend more. They must de-risk more through guarantees, blended finance, and local currency solutions that reduce investor exposure. MDBs need to start acting as market makers, especially in fragile and frontier markets where geopolitical risks discourage private capital. They also have a unique role in crowding in climate-aligned finance by setting standards, absorbing first losses, and funding project preparation. This will help mitigate the hard reality we are facing, which is geopolitics is pushing global climate finance to focus more on domestic frontiers in the global north. International investors, they remain hesitant, but they are interested. The private investors face new constraints. Higher interest rates at home, raising global risk aversion, and shorter time horizons. Yet Africa offers demographic growth, resource endowments, and green investments potential that align with long-term mandates, especially for pension funds, sovereign funds, and ESG-driven portfolios. The potential needs to be unlocked. What do international investments need? They need regulatory certainty. They need co-investment opportunities with multilateral development banks, as well as DFIs. And they also need more transparent pipelines of bankable projects. As a final thought, let me just state that in this emerging era, multilateral development banks must act as geopolitical stabilizers and capital mobilizers, helping Africa remain investable amid global uncertainty. And international investors must move from a wait-and-see posture to a co-creation approach, working along DFIs to shape investable environments, not just to respond to them. In short, the financing gap will not be bridged by capital alone. It will be bridged by confidence, and the confidence must be built through partnerships, risk sharing, and long-term vision. Thanks.
Thank you very much, Austin, for your submission. I really liked how you talked about the role that the multilateral development banks should play, and particularly to the international investors and their role of co-creating, a posture of co-creation. And the market will also be built by confidence. You hampered on the perceived risk. And my next question will go to Handia. Risk is an issue for this continent and something that stands in the way for us mobilizing massive capital into Africa. So what are the biggest risks associated with mobilizing capital at scale, and how can they be mitigated?
Thank you, Etimori. I think for mobilizing capital at scale, if you are looking at internationally, a lot of the issues has to do with this risk aversion that Austin talked about, and it's a lot more of perceived risk that we see more than what is the actual risk, but that is really what confronts Africa. And also currency, the exchange rate volatility doesn't allow us to perform, in this aspect of investment. And so institutional investors looking to invest within the continent are looking at the currency situation. So currency is a big issue. The other risk is deployment risk, so more around pipeline, because the thinking is that we don't have enough bankable or investable, I call it investable projects for us to be able to use to raise a lot more capital at scale. And internally, one of the biggest risks we have internally raising capital locally is also government borrowing, which I think Amit had talked about a bit, because government essentially crowd out private sector by borrowing too much in the domestic market, taking a lot of money from institutional investors, leaving not much for private sector, but we need private sector to grow to be able to support with the development. The other one is the interest rates. Because of the nature of the borrowing, there's a lot of, in the interest rates in our economies are actually very high.
I think we've lost Hamdia there. So while she's getting back to us, we want to shift the question now to you, Hamid. Hamid, looking at all of what is going on, we want to shift the conversation to looking at your small country, Mauritius, in the face of all of in the face of all of this trade wars and big geopolitical shifts, we see countries like America issuing tariffs, to countries like lollipops given to children, and the agitation is creating. So this has resulted in a slowdown in global trade and commerce. And you mentioned earlier on that Mauritius it depends on 90% of imports. So how can we see small countries like Mauritius secure more domestic and international capital for impact investments? So what would you do, and what can we learn from you that we can scale across the continent?
Exactly. That's the idea here. The pilot project here that we are trying to implement in Mauritius could be used as a model. Let me get back to the issue that you've raised here, Itimori, and the Amadia, the point she raised also. So if you look at the context of Mauritius again, 75% also of our energy needs are met by fossil fuels, which means there's still massive underinvestment into renewable energy. Obviously, I've said sustainable agriculture because we import most of our foodstuffs. So we need to invest more into sustainable agriculture, vertical farming, biofarming, renewable energy, blue economy, all these emerging sectors. We have not invested up to the optimal amount. On the contrary, we have invested beyond the optimal amount in real estate and financial transactions. So what we are looking at here, let's forget about this technical term, which is called quantitative easing. It might turn people off. It's very simple how it works. Government, I'm saying it here, government cannot wait for the private sector to invest into renewable energy. They don't have any incentive to invest the amount we need for the country. The private sector in Mauritius, as we have seen over the past decades, has a skewed incentive to invest into real estate because it makes sense for them. After 6 months to 1 year, they maximize their financial returns. Whereas if you look at a renewable energy project like a solar park, it could take 10 to 15 years for them to even break even. So which means, therefore, that we need to create business models where government initiates those investment into those impact sectors by directly borrowing from commercial banks. Why am I emphasizing on this point here? Commercial banks. Because if you read the work of those Nobel Prize winning economists, they say when banks create credit, they create new purchasing power, which has tremendous effect on the growth path of an economy over time. Therefore, we are saying in Mauritius that, okay, we won't wait for the private sector because we have seen what they have done over the past 30 years. We don't believe in the crowding out effect that some economists have been talking about. We say that there is underinvestment in agriculture, in renewable energy, in blue economy, in fintech, in ICT, and government needs to step up to create business models with foreign investors which have the technological know-how, joint ventures, be it 5149, whatever business models you're talking about. But where will a country like Mauritius with 644 billion rupees of debt get money to invest? This is where we are saying when fiscal policy lever is blocked. Yesterday, we talked about it. It is monetary policy which will step in here to direct bank credit creation to those impact sectors to reach to that optimal level of investment which we want to see, which will reduce our reliance on imports and make us more food and energy sovereign. So that's a bit how the mechanism works. And I'm quite excited because I'm in direct contact with some of the prominent economists around the world, and they're very keen to help us in Africa to implement those kinds of policy reforms. We can talk about it later. Thanks, Itimori.
Yeah, thank you so much for that, and for also mentioning policies, because policies are very important to help us direct capital to priority sectors. You also mentioned the fact that policies had worked in tiger nations, which I'll call it, to just give us some instances of how we can transform Africa with policies, and government being very interested in working with the private sector. So still on policies, let me call Austin to speak to what kind of policies we are seeing in Zambia. What can we learn from these policies that can reform SME lendings across Zambia and also across Africa? And then Hamid will come to you to give us a regional perspective on what we can learn from the tiger nations. So let's start with Austin.
Thanks a lot. I mean, to begin with, what is clear is that Africa holds immense promise. It has the world's youngest population. vast natural resources, but has an SDG financing gap estimated at over $500 billion annually. At the same time, we are beginning to see a global shift. Impact investing assets surpassed $1.5 trillion in 2024, according to GIIN estimates. This represents a 21% compound annual growth rate since 2019. Yet Africa captures less than 10% of that. And this is primarily due to weak policy ecosystems that fail to connect investor appetite with investable, impactful opportunities. This gap requires to be closed. How do we do it? To close this gap, governments need to start going beyond traditional investment promotion and begin to embed impact investing directly into development planning and public policy. You mentioned Zambia. Consider Zambia reflective of many peers in the region. In Zambia, for example, the 8th National Development Plan, 2022 to 2026, does recognize the private sector as a key to development. It also formally identifies impact investment as a key source of financing for the National Development Plan under its integrated financing framework. Missing, though, is a meaningful articulation of how to systematically attract the desired impact capital. Yet the opportunity is there. Zambia pension assets exceed $3 billion, but only a tiny fraction is invested in SMEs, green infrastructure, or social services. This is not due to a lack of intent, but a lack of structured policy incentives. So, in wrapping up, here's what I think can work. One, there has to be alignment of development plans with impact investment frameworks. A growing number of countries, South Africa, Nigeria, Ghana, Kenya, Zambia, etc., have taken the lead establishing National Advisory Board on impact investment in partnership with GSG. These platforms link investors, policymakers, and businesses around national development goals. Similarly, integration across Africa could unlock coordinated policy shifts, such as tax incentives, blended finance pipelines, and legal recognition of social enterprises. The current initiative by GSG Impact to support selected national partners reform the policy space will likely begin to fast-track policy realignment to embrace impact investment in a structured way across Africa. Use of public resources to de-risk private capital is also important. Across the region, blended finance facilities have proven effective. For instance, in Zambia, an agriculture-focused blended finance model mobilized over $20 million in private capital into smallholder finance. The Small Business Growth Initiative, which I talked about, is leveraging a $175 million central bank-funded credit risk guarantee scheme to unlock sustainable financing for MSMEs through a structured risk-sharing mechanism. Scaling such approaches across sectors like affordable housing or healthcare could be transformative. Then we look at mobilizing local institutional capital. Pension funds in countries like Nigeria, South Africa, Zambia are growing rapidly, but asset allocation remains conservative, constrained by regulations and the lack of investable impact vehicles. Governments can support impact fund of funds, revise prudential rules, and incentivize local institutional investors to participate in infrastructure and SMEs financing with social environmental returns. There is also a need to build market infrastructure and accountability. Impact investors need data. Establishing impact measurement frameworks linked to SDG targets and supporting platforms that match capital with credible enterprises are critical. These efforts will increase transparency and trust, reducing the cost of due diligence and
Thank you, Austin. If I should just chime in, thank you for giving us your
more capital.
Can I chime in, Austin? Sorry, because of time, you've really given us an in-depth um, uh, content to look at how policies can transform the entire landscape, not just only the micro, just the monetary and fiscal. You also looked at the market itself. And thank you very much for that. So we'll come back to you if we have time to dig in a little bit deeper, particularly with how policy has transformed your landscape in Zambia. You gave a good example with FSME lending, with the small growing business financing and how that can be scaled across the continent, and also other sectors in Zambia. But because of time, let's look at some questions. And the first question I want to pick here is a question from Shane. The question goes like this: with global demand for global services, gig work, professional and digital services projected to exceed 15 trillion by 2033. The fact that the mature markets have declining and aging populations, and Africa to contribute half of all new labor force entrants by 2030, how can we attract scalable impact investments to develop, and transform Africa's 1 billion working age youth into globally competitive, export-ready digital and professional talent force? Can I ask Hamdia to answer that question from Shane? I hope you see the question. And while Amit, I'll invite you to please answer the question on the chat box. If you can type the response directly, that would be good. Thank you. So Hamdia, can I invite you to try that?
Yes, thank you, Timori, and thank you, Shane, for the question. Yes, I think that it is an opportunity for us, but it's also a challenge. We're going to have a youth boom, and we need to have an educated youth. And we need to channel a lot of effort in education, in skills development, to ensure that we are coming up with young people that can fit, that are trained and fit for purpose for these sectors. And yes, it all has to be driven by policy and investment. And we need to begin to look at how we can potentially support. There are a few institutions already coming up training African youth for some of this gig work already. And we need to support a lot more. We need to use policy to be able to direct more funding to some of these early stage thinking ideas that can expand into global businesses. And that is how we should be looking at it. So policy plays a role that directs investment towards this. We need to be more futuristic, and we need to look at our education and our skills development programs.
So thank you very much, Handia, for your thoughts. I hope, Shane, you're satisfied with that. If you're not, I will invite you and others who would want to dig in deeper into the conversation to join us in Accra on June 11th to 13th for the Africa Impact Summit. Please, we'd like you to also participate virtually for those who can't be in Accra. Links will be placed on the chat now, so please register. And also, for those of you who will be coming to West Africa, why don't you stop over in Lagos, Nigeria, for the pre-event study tour to meet business leaders and investment opportunities in Nigeria. So looking forward to seeing you. So before we round up today, I just want to invite each and every speaker to give us your final thoughts in 2 minutes. I'll start with Austin. Give us your final thoughts in 2 minutes.
Thank you. I think, in my view, the challenge before us is structural. The capital is there, but the architecture, incentives, and vehicles to move it where it matters most are often missing. 3 parting thoughts. We need to think systems, not pilots. Mobilize capital at scale means institutionalizing what works, not just proving that it can work. Move from aid to architecture. Public capital should activate markets, not replace them. Empower local actors. The future of scalable finance lies in regional capital markets, domestic institutional investors, and policy and strong policy frameworks. Thanks.
Thank you very much. A lot said. Institutionalize what works. That's often missing. Also, getting structures where that can receive and mobilize capital within the continent, empower local actors, and so many others. Thank you very much. So, Amit, your final thoughts?
Thank you, Mauricio. I'll just seize this opportunity again to highlight that past experiences of successful countries are great examples to be inspired. And Japan, after the Hiroshima and Nagasaki, used window guidance after the World War II, rebuilt their country by using window guidance, direct credit creation to industrial production. It worked wonders. South Korea did the same. But note of caution, Philippines, or with the dictator Marcos, or Suharto in Indonesia, directing credit creation to individual supporters, political cronies, is dangerous. So we are advocating for sectoral intervention, not individual intervention. And I would also want to highlight that FDI, that I've alluded to, works very well with Africa. Many countries or many multinationals would be very happy to come close here to Africa because our market is huge, right? So combining those FDI models with technological transfer, skill transfer, with local monetary policy reforms, for instance, can mobilize capital at scale to address the challenges we have, especially that we have been lagging on progress made on the SDGs. We talked about this, Etimore, and we want also to take up this conversation during the summit. And again, thank you a lot for this opportunity. I think we have a lot to say, obviously. Thank you a lot. Yes.
Yeah.
Yeah.
Thank you very much. I mean, a lot to share about the quantitative easing. I hope when we get to Ghana, you tell us more about the quantitative easing.
We'll talk about it then.
We can use it positively, for Africa.
Yes.
Thank you very much. And Hamdia, your final thoughts?
Yes, so my final thought is that we need to be able to build our economies. We need to support economic diversification through value addition so as to reduce our dependency on primary commodities. So we need to use policy to encourage institutional investors, local institutional investors, to be able to invest in domestic projects. We have over $2 trillion in pension assets in the continent, and this represents a significant pool of capital. And if we are able to create that enabling environment to unlock some of this capital into the real sector, that could be a very serious game changer. And I think this should be something that we all should be happy to push and to make it work. And we also need to have more institutional grade vehicles that we could channel this massive capital through. And what I just want to say from our lessons in Ghana is that you need to engage the local institutional investors very early at the design stage. We need to understand their needs. Yes, they are risk averse. There are also capacity issues. So we need to make sure we engage them early to understand what they need and to design vehicles that is consistent and bring a lot of expertise on board so that we are able to leverage this capital for good, for the development of this continent. I look forward to seeing you, hosting you in Accra from the 11th of June. And thank you so much.
Thank you very much, Hamdia, for that summary. Support economic diversification, encourage more institutional investors. I want to say that Ghana is doing quite well with your policy, and with the Chigaba, we see pension funds, moving to participate in that vehicle, which goes back to Austin's point that we need to see more of these kinds of vehicles that would unlock local capital And just to point that here in Nigeria too, we are doing the same thing with the Wholesale Impact Investment Fund, engaging actively with pension funds from the design phase, and they are really excited about such vehicles. So we want to see more policies that will drive more local capital towards impact areas. And this conversation, I should end by saying we'll continue in Accra, Ghana. So please join us, be our guests here in Lagos, and let's transform systems in Africa. Thank you very much, everyone, for joining us for this very important conversation on mobilizing capital at scale in a changing global landscape. So we need to mobilize capital for Africa, and please join us in doing so. Thank you very much, everyone, and enjoy the rest of your day. Thank you.
Bye-bye. Thanks.
Bye-bye.
Bye. Bye. Thank you.